Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn Associates with your financial update for this December 26, 2017, just after 4:30 p.m. Central Standard Time. Let me welcome you all back from Christmas. Hope everybody had a great holiday with your family and so on. The problem we all face now is we're going to trade on Wednesday and Thursday, and then we got a small trade day on Friday as everybody breaks away for New Year's. We really don't start serious trading until a week from today. A Tuesday, 1 week from today, the 2nd of January, I believe it is. So whatever you think you're going to do, what can I tell you? You work with it. Now, in the stock market, they tried to break it today, then they brought it back, but you're trying to make something out of nothing in the last 3 days of the year, and that's the reality of the situation. Bitcoin had an interesting move. The markets finished up pretty good. It came back from the, 11,300 a week ago, and now it's pushed up to 16,000 again. The swings, though, are so violent. How do you properly margin and account for it? That becomes the issue, especially on the short side where there's nothing to deliver. And that's what scares firms. If you get into a squeeze play where the buyers just come out en masse, what's to stop it? It's not as though you can deliver something against it. So plenty of issues still there, but plenty of good. Number one, blockchain. Love the technology. I saw today that a company in the colored stone business, sapphire specifically, came out and they said they're going to use blockchain and they're going to keep records of everything they grade with it. Now think about the logic of that. Imagine all the stones out there that get different appraisals from everybody. I'd love with a blockchain to go back and say, well, this company graded it this way. Why are you grading it that way? Obviously, everybody's an expert and everybody has different opinions, but just take that one step at a time to everything you could imagine, and that's what blockchain offers down the road. We saw today that in Libya, there was a strike against one of the pipelines. Now, it produces, that pipeline carries to the port 90,000 barrels a day. Add that to the Forties pipeline in the UK, and it's a loss of 550,000 barrels a day. Normally, I'd have said crude would have broken today because the Forties pipeline owner said that they are starting very slowly to turn back on the pipeline, to repressure it. They're checking it at each of the seals that they have fixed to be sure of everything. You would think that'd be bearish, but when you lose another 90,000 barrels with something like this, the market is telling you how to out of supply. On the other part of the market, imagine you're a shale producer and you're in February and you got $60 a barrel crude, and if you look back 4 or 5 months, you can lock in profits going forward for quite a while. I can't see how U.S. shale producers aren't jumping up and down. You know, low-cost producers can be in the $20, $30 a barrel. You can get to the medium producers that are 40 to 50, and they've still got 60 here. If you're in the shale business, you should be jumping up and down and turning on all the rigs you can. So let's go to the S&P. We know the stock indices are strong. It's the end of the year. Will they see a further rally? That's the big question. But if you made your money this year, you made it. If you lost your money, you lost it. The last 3 days of the year shouldn't be all that important. And you're seeing on the daily area chart the sideways action that is now kicked in. And when you look at the bar chart, you see the shrinking up. You can get spikes up or down real easy at this time of the year because there's not a lot of traders. I was on the floor today doing a TV show. I'm talking the floor at the Chicago Board of Trade here. And to make a long story short, there was nobody around. And that's one of the things you have to think about in markets like this. You're still in an uptrend, but you're starting to back away a little. If we look at the high here, this high was 26.96. This high was 26.98. You actually have a pattern of higher lows and lower highs. Market is now sidestepping and trying to figure out what next. Get over 26.96, you probably capture this group that are trying, whatever reasons they're doing, selling anything. maybe you get some more spark to the upside. Break down from here, you might go to the 18-day average of closes, 2664. In terms of the Bollinger Bands, what I teach in my charting courses, once you learn Bollinger Band theory, like the sideways action that you get in markets here, often leads to a breakout to the upside or downside. But it's the sideways action that typically sets it up, not this that sets up a decline. It can often go from upward action into sideways action again. Momentum-wise, the slow stochastics are super interesting because they're an oscillator that gives you an idea, and if you believe as I do that momentum leads price, they're saying that you're still very much in a bull side. If the red line gets under 80, it's a big warning signal. Maybe it's time to run out of Dodge, and you had that happen today in the NASDAQ. If you look, the NASDAQ closed with the red line under 76. Now, the days prior to this, both numbers were over 80, both numbers over 80, over 80, over 80. So this is called a loss of the momentum. It doesn't mean a lot because all I'm looking for is the 18-day average of closes. However, once you get into 2018, and if you start looking at seasonal trades the way that I do, got to be a little careful. This market often breaks in January. What else? Apple's sales. Analysts came out today and said the Apple 10 isn't doing as well as they were hoping it would do. You know, when Apple sneezes, everybody in these indices seems to be Apple-oriented. You know how much of investment's in it. Market was down today. NASDAQ is down today. Dow, look at the sideways action here. Momentum's still embedded. The trend is still up. But like the S&Ps, we can come here and we see this high is 2486, and this high was 24896. So we actually have a pattern of lower highs, that's 24860, and lower highs and higher lows. The way it breaks out, if it comes out to the upside, look for 24,987. If the market starts slipping under 2470, maybe you go back to the 18-day average of closes. You don't have to do either. I'm not predicting. I'm just saying as a chartist, those are the two possibilities I'm seeing on the chart right now. In the Russell, you're overbought. You have patterns here, again, where I'm not in love with them. You're getting patterns here that stall against the upper Bollinger Band. This was 1556.90, and this high was 1557.30. So as small as it is, you still have a pattern of lower highs and higher lows in an overbought market that has upside bias, but if it decides to back off, it might go to that 18-day average of closes. The VIX is neutral. The red line represents what I call the neutral line on a chart, the line in the sand. It's the 18-day average of closes. Sitting on it is exact neutrality, and that's what this market seems to be doing. In the interest rate sector, you know, we saw interest rates go higher as the U.S. tax bill was passed, and as China literally at the same time said they were going to ease some credit restrictions. Interest rates higher, and all of a sudden now, for the past 3 days, we're starting to get a reaction the other way. Resistance back up at 125 to 126.35. You have no trend here. You've got the swing line pointing up, which is definitely an uptrend. However, it is filtered by the 18-day average, and when you're under it, you have nothing. You have a market that's got the swing line up and the bias down. In the T-bonds, it's the same thing. You've got higher lows, higher highs. Maybe you can rally into the 18-day and 100-day average. You're oversold. I would not call this a trend anymore. 10-year notes, same pattern. Higher lows, higher highs, but under the 18-day average and oversold. In the dollar index, the trend is down. Lower highs, lower lows. And yeah, over the weekend, over the holiday, I was reading about articles that were saying how much money's going to flow back into the U.S. because of the new tax law. It may be, and a lot of people think that's bullish. It still might be. All I'm really seeing here is while the trend is down, sideways action in an oversold condition that is in a bearish trend. If it decides to move lower, it might go to the lower Bollinger Band. If it gets over 93.09, you negate this pattern and you're back to square one, not much of anything. The flip-flop, the mirror of this, is the eurocurrency. You have higher lows, higher highs. This is why swing lines are important. They get you out of just the sideways look of a market. In fact, if I were to take the Bollinger Band off, you wouldn't even see how sideways this is. Your eye would probably see something different. As you put on these different layers that I teach in my charting course, patterns start to develop, and until you take out 118.92.5, you have a pattern of higher lows, higher highs. Admittedly, you're in an overbought condition in an overall sideways market, but until you take out 118.92.5, a potential target is still the upper Bollinger Band. Aussie dollar has been in an uptrend for quite a while, still running there, embedded reading. In other words, you converted this market from being overbought, and now both the red and the blue lines, they're called the K and the D in the stochastic, are going sideways over 80 or pointing higher for several days. That means the market is no longer overbought. It's converted into a much more bullish situation, and that often is accompanied by higher prices. I use the word often. I have seen where it isn't, but in this case, it's doing it. Should it keep reaching up? Maybe. You get another resistance point at the upper Bollinger Band and the 100-day average of closes. In the end, we have a situation of higher lows, lower highs. As much as the overall pattern is bearish, resistance being the 18-day average, I hate when you get that pattern and I walk away from it. Bitcoin. Notice the sideways action we're getting. And if I took you all the way back in this chart when you got down to that 12,000, 11,300 level, it came from a pattern that was sideways, and then the market started building on it. If this market decides to break down, first support 15,520, let's call it. Next support 15,027. Momentum down, no trend right here. You got a higher high and a lower low at this point. In the crude, what would you expect when you heard about Libya today? I would expect that you'd see higher Brent oil. Countering it was interesting. Before that happened, you weren't anywhere in the energies, and the news of the 40s pipeline that serves the UK, it was coming back very slowly, but coming back online now, and they were reopening, I think it's the Keto refinery, and getting that ready to go. So normally that'd be bearish, but once you lose 90,000 barrel potential a day out in Libya with an armed militant strike, and that's what happened. You add that with the 40s and you say, hey, it's still not back online, and look at how you jumped up again. Rather dramatic. The beauty is you're carrying both the Brent and you're over the upper Bollinger Band, so it either runs now dramatically to the upside or falls back within that band, and the WTI did the same. Notice the sideways action here and here. Still bullish, overbought, overbought, over the upper Bollinger Band. You either immediately pull back, and immediately day or two, or the market starts pushing these bands out and they start arcing to another price level using this as a base. Right now the bulls have control of the situation. Gasoline, not quite the same story, not the same sideways action, but over the upper Bollinger Band, the product's getting dragged along with everything at this point. What are the odds of staying over an upper Bollinger Band or a lower one? 5% of the time. So 95% of the time, that will not stay over the band. Doesn't mean you can't work higher, but you'll have to do it from the other side of the band over time. Nat gas. If you watch the weather across the East Coast, the Midwest, how cold and how lingering this cold is. I mean, it's brutal out in Chicago. We're not going to be into the 20s for 10 days. Not going to be there, they're saying. So, wow. You can't hold a rally. Not very good action, and the reason is they're still bringing on these natural gas. As the shale prices go up, you're going to produce more. That's the logic, and you're going to get gas as a byproduct of it, and there's too much of it around. That's what the market is saying. I want to remind everybody, I got a prediction for you, and please listen real carefully. My charting course, right now it's $129.95. I'm kicking it up nearly 20%. January 2nd in price. Up until I kick it up, it's $109.95 less $30, nearly, think about it, 40% discount or so from that price, $79.95. It includes all the videos that come with the course, 6 hours. It includes the charting software that comes with it, my research that comes with it. We're going to teach you how to use slow stochastics, moving averages, Bollinger Bands, window envelopes in a 5-step process to build a game plan on a chart. And how I do it is, you're going to see, not only do I do it using this, your chart's going to end up looking like this, and I cover the name of the chart. I don't want you in most cases to know what the chart is that we're looking at, and then I surprise you with it, because what happens is, let's assume gold's running right now, or Bitcoin's running. You're going to be, by the press, swayed by it instead of being ice cold and looking at a chart and saying, this is the action on a chart. Will you always be right? It's a guarantee you won't be. Will you have a game plan? Yes, if you follow it. Will you know where you're wrong? Yes, you will know where you're wrong. Will you know how to add on to positions if you want, or hold them for the longer term? Well, that's the goal of what we try to teach in here. You will be able to take this and develop it in ways that you can use it as a base. Some people will use it as their complete tool. You'll decide. But remember, a chart being a chart means it's an ETF, it could be a stock, a futures market. What I've decided to do is make the course available through the end of the year for $79.95 as long as you use the code word XMAS. No apostrophe. Don't worry about caps. You're going to get my twice daily updates. You're going to get the daily numbers, as we call them, access to the morning video where I cover 40 charts, load you up for the day's trades, ideas for day trading, position trading, all there. How do you get it? You can either call my staff. A lot of you, and over the holiday we saw that, they went online, and under the keyword education will be the course, all the questions about it. Be sure to put in your coupon code, and away you go. You can click up here if you're watching me on YouTube. Put in, again, that'll take you right to the key page. Use that word XMAS. We'd like to put it in your hands. Don't do it. Instead of $79.95, if you decide to get it in January or so, it's $129.95. I'm Ira Epstein. You have a great day, and I will see you all tomorrow.